Hello, this is Ken Tomko at T2 Asset Management doing our monthly review of what's going on in the markets. As always, please don't use these videos for trading purposes or for education only. We start here with the weekly chart of the S&P 500, and this gives us about the last 6 years trading, give us an idea of what is going on. So we have just a little bit of 2019 here left on the left side, and then there's the COVID sell-off and the run up through 21. And then as the Federal Reserve started to raise interest rates, we had a bear market through 22, and then 23 was pretty good, and 24 is off to about the same. Right now, we currently do have an uptrend going. I probably could have redrawn some of these, but I'd say the major support is still this level here. Did break the trend line going lower in July, but has recovered since, and we're actually testing new highs again, although kind of bouncing off of it at the moment. But I'd still say we're in a bit of a uptrend as of yet, as of course we're sitting near the all-time highs. We come down here to the daily chart, give us a little more room. I've drawn a trend line here under the latest test. As we came down here, we got pretty close to the 200-day moving average on the S&P 500 and bounced nicely off of that. Once again, still testing these highs. We have a lot of sort of support in this range. I think as long as the market's holding above 5,500 or so, we still have a breakout and up to all-time highs. But if you look, I think if this broke down here and certainly broke our trend line, we'd start to have some trouble. Nothing there yet. As of yet, our longer-term stuff, our weekly chart or daily chart, they're still positive in an uptrend. Come here to a little bit more detail. This is a 2-hour chart, so each of these candlesticks is a 2-hour trading period. Gives us about the last 6 months, and so a little more detail on what's going on. And you can see here was the pullback that we had through July and August, and it got pretty steep there for a minute. It certainly did, but has since recovered back to the highs, giving us a little trouble today, as you can see. But look, I mean, here's the last couple of weeks. We've just been trading back and forth in this range right at the all-time high. So really nothing to speak of yet. If we go here and look at some of our breadth measures, gives us a little better idea of what's going on inside the market. You have this first one is the percentage of the S&P 500 that's in an uptrend, and right now that's sitting at about 68%, which isn't bad. So to be sitting up that high, about 2/3 of it, I mean, we had much less during some rallies earlier in the year. So we're getting a little more broad participation than we had before. And I'm not seeing any breakdown as of yet, as we're at this all-time high. This next one down is the advanced decline line on the New York Stock Exchange. And again, it's showing health. Certainly, right, you could look and say, okay, it's rolling over slightly at the moment, but not really. I mean, both of these are, I'd call them flat. And finally, at the bottom here is the VIX, the volatility index. And usually we'll see that when the market's really starting to break down, people are going to buy puts to protect their options contracts that make money when the market goes down. They'll use that to protect their portfolios. And when that happens, like here, you see in August when the market sold off, the VIX, the volatility index, will go really high, which just basically says people are paying a big premium for that insurance. Right now, we're not seeing that happen either. So internally, I'm not really seeing much to worry about. Yes, we have been hit the all-time high and haven't been able to get through it. So I don't know that that's positive. We've been up there for a couple of weeks and haven't really busted through, but I'm not seeing anything that's saying panic as of yet. We go here and look at interest rates. This is the interest rate on the 10-year U.S. Treasury bond, and you can see here we're hovering right at about 3.85%. Had gotten as high as 5% there in late 23 and have backed off as the Federal Reserve has walked away a little bit from raising interest rates further. So decline in those rates is actually fairly positive for the market. It's less cost of capital for companies, and also it means that bonds pay less than stocks, making stocks more appealing for the time being. So nothing too much to worry. I'd say it looks like here, if you look at it, the last 3 years, we've really just stayed in the same range. So it's pretty healthy there. If we go to look at some of our economic indicators, You go here, trading economics, and get that GDP annual growth rate. These numbers are actually pretty solid. There's always this talk of recession coming, and it just hasn't really shown up yet. Although non-farm payrolls here, this is not a very great number. Those are low. And in fact, last month they revised and said there were 800,000 jobs that they had claimed had happened in the last year that they just wiped out and said, oh, those never happened, because these are based on surveys. There's not actually jobs. And some statistical measures in there too. Inflation rate seems okay. We're hanging around 3%. Federal Reserve wants to certainly get a little bit lower, but we're not sitting at the 8-9% that we had been a year or so ago. And then if I go down here to retail sales, they're still positive, so that's fine. So overall, I'm really not finding too much terribly to be concerned about in the markets. It's not really just showing it. Certainly, people can prognosticate and be saying, hey, this is what I think is going to happen, but I tend to just pay attention to what is happening. And right now, things are pretty solid. If we go here to forward earnings estimates, we have, as you can see here, the analysts are still believing that earnings are going to be very solid for the S&P 500 going forward into the fourth quarter of next year. So really not seeing anything across the board to be too worried about yet with the markets. And if finally, this is my one concern, I've said this in prior videos, is that our valuation is quite high. If you look here, this line is what 20 times earnings on the S&P would be. And I think that's probably a pretty normal place to be. And this is where the market is. So we're certainly at a bit of an overvalued place. But earnings could come up and meet it, and all of a sudden we wouldn't be overvalued. So that could happen, but I would say still we are in a fairly expensive market at the moment. So anyway, hope that is helpful and informative, give you an idea of what we're looking at in the markets right now, and still staying positive on things. So we have a little bit of caution. There are a couple of things that are a little worrisome, and this is one of them, having this valuation. But I think the election is probably going to be a big driver, as vastly different policies are going to come into effect depending on who wins that. So anyway, I hope this was helpful and informative, and I'm going to put up our contact information here. See if I can do that. There it is. And if you'd like to hear more about what we're doing in our portfolios, how we're helping clients, please don't hesitate to reach out. And otherwise, hope it was, again, informative and helpful. And we'll see you at the next update. Thanks.